we offer the certainty of the price of the deal, the docs, they're not changing on you depending on how the market goes. What we won't do is we're the tail of the dog, and so we're a 5-10% position and others are much larger. That's not what we want to do. If you're in a facility that actually enables lenders to trade out, who are you going to have around the table when there's a problem with it?
Welcome to Termgrid Talks. Today the spotlight will be focused on private credit. I'm Anthony Sage, and I'm delighted to introduce a friend of mine, co-head of direct lending and portfolio manager at Hayfin Capital, one of Europe's leading direct lending and private debt platforms. Welcome, Marc Chowrimootoo.
Good to see you.
Perhaps we can start by diving into looking at 2024 and the context of what's happened across the market and what your key observations have been.
Thanks. It's actually 2024 has been a really interesting market to be in. Despite the sort of themes around low M&A, low volumes, increased competition from the syndicated markets, we're on pace to actually deliver the highest level of deployment in direct lending since COVID. Mm-hmm. So we've managed to find a way to deploy in really interesting spots, even though overall volumes are low. I'd say one of the themes we're noticing is a continual increase in M&A activity. It's starting off at a very low base, but we do experience and have experienced that sort of slow ratcheting up. And actually the teams are probably operating on more lender ads and more processes now than they've done at any point in the last sort of 18 months. So that bodes well for 2025 and onwards. We also saw a real uptick in refinancing activity, certainly from Q2, which has added to the volumes of that low M&A base. The syndicated markets and sort of how that's impacted us. It's had some impact on spreads, without any doubt. But what's notable is that even with sort of spread compression, pretty severe spread compression in the B loan markets, ours is sort of matched in sync, and so it's still delivering a sort of 150 to 200 basis points premium to the B loan market, which is actually what's happened over the last 15 years. So whilst it seems like a really dramatic move this year, it's actually pretty normal for our market to move in tandem. And look, we're still finding really interesting spots to deploy, both from a sector and as well as regional perspective.
I think that success somewhat surprises me, just in the context of the, as you said, the compression in the syndicated loan market. They're 150, 200 basis points inside of you. The M&A activity has improved, but still somewhat suppressed. And against that context, I would have expected the sponsors to perhaps veer away from you and towards the syndicated loan market. What do you think the differentiating factors are for you guys?
So before I get to the differentiating factors, I think we need to reset a little bit what the market opportunity is. I always use the analogy of the Venn diagram. And so you've got the syndicated markets, B loan and bond markets. Over here, you've got private credit more broadly and direct lending in particular, and that overlap in the middle. And we tend to spend a lot of time talking about that overlap and that tension between asset classes, and the narrative is about sort of the battle for ascendancy between those classes. What it misses is that the really interesting space for us, the white space for private credit, is an area that isn't covered by the syndicated loan market. And so whilst there has been some compression, there is increased competition for those assets where they overlap. That white space is still growing. So notwithstanding that the health of the syndicated markets coming back, we've still been able to find really interesting places to deploy. And actually the real growth driver for private credit in general and direct lending in particular is in that white space. It's not in the areas of competition. I always remind people that actually we want a healthy syndicated market because that drives overall volumes, and that's good for M&A, which is good for everyone. And so we want to be in a system where we coexist with them, where there'll be places where we compete, because quite frankly, it's not clear whether an asset is natural for the B loan market versus the private market, or where we coexist and we supplement them. You know, there's been a increase in deals where whether that's PICs on top of syndicated deals, whether it's currency tranches within a B loan context, you know, where private credit and the syndicated markets can really have a symbiotic relationship. I think that's the healthy place for the market to go. I think that's what's really interesting. But that white space is what's fueling the growth. It's not that battle. And so coming to the point around, well, what's different about us? What are the flexibilities and advantages to us? I think there's a growing appreciation within both the borrower and sponsor community of the flexibility that private credit offers. You know, we can look at slightly different sectors. We can certainly take a view on leverage and cash flow outside the constraints of a ratings framework. I think the speed of action between, you know, starting a process and getting to commitment, I think in this environment we still offer something different. Management teams often prefer dealing with a small group of direct lenders as opposed to a syndicated offering where they've got 50 investors that they need to speak to. And I think the reliability point, I mean, if you go back to 2022 and 23, we were the only asset class that could stand that volatility. We were the only reliable asset class out there. And I think that's not lost on the sponsors and borrowers.
The symbiotic relationship between loans and private credit is quite interesting, because I thought that the convergence of terms, documentation between those two asset classes would be more difficult than the convergence between bonds and loans. And clearly you're saying that's already underway.
Yeah, I think you need to look at subsectors to really understand the movements. I think, and we operate in two distinct markets. We operate in the mid-market, classic mid-market, which for us is sort of 30 to 50 million of EBITDA, and what we term the upper mid-market of sort of 50 to 100. The median asset in our most recent vintage is sort of 60. If you look at the last 12 months, it's more like 70. So it's sort of it cuts across those two markets. There is obviously a number of assets in our portfolio that are above 100, right, which are look and smell and feel like a large cap deal in the B loan context. And if you were to look at terms in that part of the market, they would look very similar to what you and I would have been underwriting it in our previous jobs. But that's actually a relatively small part of what we do. You know, the bulk of what we do is in those two sectors, and that's where the docs do diverge. Right, we do have better protections from a documentary standpoint. We are more rigid on structural protections. You know, there's a reason why there's a much lower default and loss rate in direct lending than there is in the B loan market. But then, you know, for the assets where they're mature, it's organic growth. It's, you know, they're large scale resilient businesses. You need part of that as part of your portfolio, right? There's a place for some of those assets within a broad name, you know, within a broad portfolio that has 60, 70, 80 names. Because that's, you know, tends to be at the higher quality end. If you're going to just be rigid about, I want my old school, you know, docs and my old school covenants, and I want to stick to that part of the market, there's an element of adverse selection. Right? So for the right credits, I think we and our peers have understood the value of having that as a part of your portfolio. But it is a diversity within that. So for every large cap deal with large cap docs, we've got sort of upper middle and middle market stocks, which smell and feel like the more traditional deals that we're doing.
Behaviorally, do you see clients thinking differently in terms of which route do I go down, bank syndicated loan versus private credit?
Yeah, there's a range. There's a subset of sponsors who, you know, used private credit because that was the only game in town during that sort of 22-23 period, and have learned a lot about us, and we've learned a lot about them over that time, and have become buyers of private credit and the flexibility that it offers and the place within their own portfolio that it occupies. Not every asset is fit for purpose, but there are certainly some portfolio companies which are more suited to private credit. I think that journey of experience and understanding of our asset class, I think has been really positive for the future growth of the asset class. There are those who are going to be more transient and will look for the last basis point in financing costs, and that will be the focus, and we'll pivot between them depending what's more attractive. And there are those that just really don't like using private credit. I mean, I know of one sponsor in particular that said to me that they've got one asset in Europe that they've used private credit for, and they really don't want to, because actually from a structural perspective, it doesn't give them the flexibility that they want, that the B loan does, and particularly with the ability to have large sort of revolving credit facilities to provide liquidity. So there's a full range within the sponsor community as to how what place we occupy. But I think what's absolutely incontrovertible is that as we come out of this period, private credit is a much better place within their appreciation and usage than we were going into it.
One point I want to pick up on is underwriting. I was surprised. I've spoken to a few of your peers, and it seems to be a common thread amongst many of them now to underwrite deals, not just to co-invest, sell down, but to third party, and it's much more prevalent across the market. Clearly, historically, it was the preserver banks, and they were the ones who disintermediated and made the money on that side. Are you seeing that more and more across your peers? Is that something you're considering internally?
We have seen instances of it. I would say from the shop floor, it isn't widespread. It's not a commonly used technique. But if you think about it, and if you contrast what's happened in the US market and our market, tends to follow the themes and trends that are prevalent there, that Rubicon has already been crossed, right? And so it, in our mind, it's just a matter of time. And then from a origination and sponsor relationship perspective, it's much easier to go, look, here's 100% of commitment. Yeah. Don't worry about the rest. We'll sort it out ourselves. We'll sell it to friends and family. Yeah. We'll negotiate docs. We give you, you don't need to pull together a club. We'll do that for you. That's a much stronger proposition than saying, we'll do 100%, but by the way, you want some flexibility, so you got to bring other people in. Yeah. We haven't done that. We have, as you mentioned, we have pulled co-investors inside alongside us in order to meet larger and larger ticket demands. But I don't rule out at some point in time us developing capability from a capital markets perspective to move in that direction. It's just probably not right now.
How big do you think that could be in terms of absolute ability of a club of direct lenders to go in and position themselves on a deal?
Well, I mean, you've seen sort of deals north of 4 billion being done by a cabal of lenders. So, the capability is definitely there. Yeah. I would say the number of transactions in Europe that are above 2 billion, even for the syndicated market, is actually quite limited. Yeah. Right? We've never had the volume of sort of mega cap deals in Europe, and so is that really going to be the path forward? I doubt it. Yeah. But the mode where we're 2, 3, 4 lenders in sort of a billion to 2 billion deal, I think that you'll definitely see more of. I mean, quite frankly, we've seen a lot more of it even in the sub-billion cap stacks, and that's just and that is a theme that we've seen that's been sort of across the Atlantic coming into our market. About half of what we do today is in a club of 2 to 5 lenders. Half of it is sole. If I were to predict what we were doing in sort of 2 years, 3 years time, it would be more skewed to that 2 to 5 lenders. But it sort of comes down to the preference and what they're, what are the principles and frameworks around their deployment. We have made it very clear to our clients, the LPs, but also the users of our capital sponsors, that we would love control.
Is that your preference?
That's our preference.
Yeah. Okay.
We understand the realities of today's market, and so we also play nicely in the sandbox with our peers. But we'll do that where we're equal in weight, and there's a balanced syndicate. What we won't do is we're the sort of the tail of the dog, and so we're a 5-10% position, and others are much larger. That's not what we want to do. We want to have influence in our deals, and that's just our model. And so even if the market does migrate to something more of a US style, sort of a ranger-led, 10 plus people in those deals, that's not really our model. And so we still think there's a much more interesting part of the market where we can have an influence on the structures.
Clearly, private credit is attractive as an asset class. There's more money coming into private credit. Some of your peers have raised incredible sums this year. With that, I thought it'd be more intensity of competition just within private credit in terms of chasing the deals. In Europe, the top 25 direct lenders have raised over 75% of capital since 2007 in that market, which is incredible. Whereas in the US, I think top 25 have raised around 50%, so it's a much longer tail. Do you monitor competition in Europe?
That concentration that I mentioned, and you sort of highlighted, that's actually accelerating. And so what it feels like is that there are a group of larger managers who are breaking away from the rest of the pack. And so, that dispersion between the leading group and the rest is becoming wider and wider. That's from a capital raising perspective. That's from a relationship with a sponsor's perspective. That's from a deployment perspective, and that feeds into performance and therefore back to capital. Why is that more prevalent in Europe than it is in the US? It's just harder to run a direct lending business in Europe than it is in the US.
Okay.
To operate an origination, sourcing, and execution business that can cope with deals in Italy versus deals in France versus deals in Germany is very much more intensive, both from a people and time management than it is in the US. And so those that have an existing footprint, those that have relationships, those have been here for a long time, they have a competitive moat around them, right? It's, we have 9 people in Paris, we have 6 people in Madrid, we have 6 people in Frankfurt. It takes a lot of time and effort to replicate that. And so it becomes very hard as a new entrant to compete with platforms like ourselves and our peers.
Quickly, just looking at the themes that I'm reading in the market around trading and perhaps building some liquidity into the private credit market. Maybe it allows the illiquid premium of private credit to be compressed and therefore become slightly more competitive with syndicated loans. Do you see that marketplace evolving? Do you care from a Hayfin perspective whether that happens or not, or are you happy to be illiquid and take the positions you're in?
So I think first thing to say is that we haven't really seen it. There's been a lot of talk. So it's pretty nascent in its evolution. Second thing is it's always dangerous to be too negative on these developments. So we have to sort of be open-minded, and I can see some benefits, right? Certainly for the users of our capital. I would though sort of just go back, well, is that what our clients want? If that's really where the direction of travel is, that product starts to look and feel a lot like the liquid credit product, which obviously at a very different price point. We offer a much lower default rate, much lower loss rate for a reason. Is that really going to be maintained if we start to move and migrate towards a market where maybe credit underwriting standards slip, but guess what? We can sell the assets into the market, so does it really matter? I'm pretty sure that's not what our clients want. And then you think about it, and the borrowers. One of the great things that private credit offers to borrowers is a direct relationship with their lender. And we can address volatility in earnings, problems with the sector, issues with the capital structure in a much more constructive way because there is a direct dialogue. There's a relationship there. Particularly companies that have migrated from bank lending up to private credit. That's really important. And so, if you're in a facility that actually enables lenders to trade out, who are you going to have around the table when there's a problem, when there's a covenant reset?
Do you think we're entering the golden age of private credit? And kind of how do you see it progressing over the next 2 to 3 years?
I think it's been an incredible ride the last 2-3 years. And it's, we were certainly at the peak of 22 where we were, for really high quality credits, issuing you know, moderately levered deals, 650 over at 97. I mean, that's, you know, for senior secured risk. I mean, that is unprecedented and triggered these views as to, well, my God, this is a golden age. We like to remind people that actually that's the anomaly, not what we're in today, right? And so actually this is much more akin to what the market was before, but also what we think the market's going to be going forward. We've certainly opened up the range of companies that we can transact with and we can build a relationship with. The size of companies that we deal with has got bigger, and I think that's not going backwards. I think the appreciation of the value of private credit has increased exponentially during those 2 years. So I see this as a springboard for the next phase of growth for private credit. I don't see this as this is it. This is as good as it's going to get. Like, you know, this is, you know, to use your term, golden age. That sort of implies that it's coming to an end at some point in time when we're replaced by the, you know, the next iteration. And if I'm, you know, and when we talk about the asset class, this is just the starting point for us, right? This is where there are structural tailwinds to our asset class. There's structural tailwinds to our growth. We're going to be talking in 3 years' time about a much bigger market, a much more sophisticated user universe, and hopefully a much more successful Hayfin to come.